Ladies and gentlemen, you're in for quite the treat because whether you're coming into this video with some experience or you're brand new looking for a way to start trading, I'm going to show you exactly what I do on a daily basis to be able to find $1,000 plus trade opportunities multiple times per day, which often allows me to be able to make $3,000 to $4,000 in a single session, risking $500, alongside our ever-growing team that are doing things like 25xing their risk on some of their trades, growing their accounts multiple X's in a really short amount of time, doing things like 70 trade win streaks, using the exact frameworks that I'm going to be sharing with you today. And this isn't because we're using a million different indicators or trying to get lucky with news or following some voodoo ICT concept. This is because we've mastered a few simple concepts to be able to enter the market in key areas and profit off of following trends. And by trading this one simple strategy that gives us these multiple $1,000+ opportunities several times per day. So in this video, not only am I going to share with you the framework of this strategy, but I'm also going to show you what the process should look like starting with a small amount of money or even no money. I'm going to show you a ton of examples of me doing this live, so you'll have this framework and hopefully be able to learn from it and apply it to your own trading. My goal on this channel and the reason why we're growing at the rate that we are is because I always want to prioritize value to you guys with an option to advance it further while keeping it fair to the private side but providing value to everyone. All right, that's exactly what we're going to do in today's video, so let's dive in. All right, so before we dive into the actual strategy itself, I'm going to show you some key simple charting basics that are going to show you how I look at the market overall. And by the way, in this video, I'm going to start basic and be able to take you to fairly advanced, even if you know very little or nothing about trading right now. So if by the end of the video I was right, make sure you hit the like button and let me know in the comments. In order to trade this model, we have to understand what we're trying to achieve overall. The first thing that we have to do is understand trends themselves. So anytime the market is moving significantly up or significantly down, this is happening in the form of trends. We can actually read trends in a bunch of different ways, but of course the overall goal is to be able to find out when these trends are happening and be able to either enter into the trends as they're moving to then be able to sell it at a higher price for profit, or find a previous trend and be able to anticipate where we think this is going to reverse to be able to enter in at the very beginning of a trend and to be able to make a large amount of money by getting in really early on a trend and making profit as it moves up. All right, and when we're looking at charts, these trends are going to be represented by groups of these candles. So you can see uptrend here, downtrend here. But in order for us to start really reading trends accurately, we need to understand the characteristics of trends so that we know when something changes, which is going to allow us to get in very early in trends and be able to have a lot of upside potential. So in trading, we consider a trend where there's a high, a low, and then a higher high followed by a higher low. But this point can only be confirmed as a higher low if something happens called a break of structure. So these breaks of structures is what's going to confirm to us that we either have the potential for the beginning of a new trend as we get our first push up. And then once we have a push up, a correction, another push up, a correction, and then a break of structure again, then we have our high, low, higher high, and confirmed higher low, which checks this off as a trend. Okay, and these details as we're reading trends are going to become more and more important as we get through the video. All right, and the reason this is important is because if we know the characteristics of a trend, when it stops having those characteristics, after there is an uptrend, there's either consolidation where price moves sideways, or there's a beginning of a new trend, in which case, if there is a beginning of a new trend in the opposite direction, we can position ourselves at the very beginning of that trend. And there's a bunch of different ways to read the current trend that we're in, to be able to enter that trend or predict a new trend and get in at the very bottom. All right, so I want to show you a few ways that we can predict and sort of evaluate the movement of trends. And then we're going to look on some charts and I'm going to show you some examples. All right, so the first thing that we can do, if we have our first, second, third point, we can actually use trend lines along this high and then dropping that parallel line down to this second point to then be able to predict a possible fourth point and a continuation up into the trend. So if we look at an example like this, we have a downtrend here where we have movement like this, and then it actually breaks out, creates a new high zone here. So now we have a potential new uptrend, which would be our high, our low. This point is higher than this point. So once again, if we draw a line from here to here down to this level, we have some reason to believe that the price could potentially bounce off of that area before continuing to make a move higher. You can see price bounces off of that area before then moving higher. All right, and so we'll notice with these trends, we sort of see these invisible walls as the price keeps reacting off of these same areas. We can draw these trend lines off of when this momentum in a certain area fails to create one of these new break of structures and now produces a lower low. Now that fundamental rule of an uptrend has been broken, and this is something called a change of character. And this is a key term to remember for later into the video. All right, and this is important for a few reasons. So you'll see as we have these multiple points of contact being created, notice how the price contacts this lower trend once and then quickly once again, and then finally has a point where it breaks underneath this line. Not only is this telling us that there's a potential for an overall shift in momentum, okay, but oftentimes what we'll see is the price come up and recontact contact the underside of this trend. I call these overside or underside retests, in which case this can oftentimes be the last contact point before a massive change in direction. And if we look at this in terms of a trend, we could be catching the first dip in the trend before seeing a full continuation in that trend if we are to see a confirmation in that change in direction. All right, and there's one final strategy that I use whenever I'm evaluating trends, which is always looking at trends in regards to something called Elliott wave theory. Okay, bear with me because if you're a beginner, this is where it's going to start to sound really confusing, but I think I can break it down pretty simply for you. In Elliott wave theory, for whatever reason, there's a natural phenomenon in people's emotion and how trends tend to develop that causes them to develop in 5 wave structures, where we have a 1, 2, 3, 4, 5, followed by a corrective move of an A, B, C. Okay, I have a lot of videos where I dive into this in detail, but there's a few critical rules that sort of allow us to be able to justify whether this is an Elliott wave trend, in which case we could really start to use other tools to be able to time perfect tops and reversal points of trends. All right, the first rule that I look for to confirm whether this is an Elliott wave is that the 2 wave cannot exceed the bottom of the 1 wave. So in this situation, this 2 level can't go below the start of this because obviously that wouldn't constitute as a high or low. The second is that the wave 4 cannot go below the high of wave 1. So technically an Elliott wave, this 4 wave shouldn't really go below this high of 1. Okay, what I'm looking for is really to see if there's a reaction off of that level, which is once again confirming Elliott wave. And the third thing is something called the rule of alternation, which basically states that if one of these sort of pullback waves is simple, the other one should be complex. All right, so if the movement of this wave is fairly simple, this wave should be fairly weird and complex. Okay, and vice versa. If this one is weird and complex, this one should be fairly simple. So anytime I'm looking at a trend, if I have this 5 wave structure that is following all of these rules, if I can count 1, 2, 3, 4, 5 waves, and we're already in the 5th wave, I'm already setting myself up on the chart to be in the general area to potentially be looking for some sort of reversal. This is where we can wait for a change of character. This is where we can wait for underside retests. And this is also where I can use a tool that I use in conjunction with Elliott wave theory, which basically shows us that if we consider this wave 1 a factor of 1, all right, there's a tool that we can use to multiply by what's called a Fibonacci golden ratio, which is basically this number that for whatever reason, everything in the universe and in nature in general is built off of. Oftentimes the wave 5 will fall at the 1.618 multiple of our first wave. I know this sounds fairly complicated, but if you're using TradingView, you can go over to your tool in Fibonacci and you can click on this trend-based fib extension. And then all you have to do is measure from the bottom to that first push up by clicking at the bottom, at the top, and then going back down to the bottom. All right, and that's going to give us the 160.18, 260.18, etc. So if we have all of these rules lining up, in addition to them hitting into one of these multiples at the high of wave 5, obviously this is a drawing, so I didn't set it up to work out that way. Okay, so let's say it did, for example, say my wave 1 was here. If we now have this scenario where we're matching up with one of these multiples, this is giving me even further reason to believe if we do have new lower low produced, we could be at the very beginning of a brand new trend. This is a pretty surface level version. I dive way more into this, of course, on the private side of our trading team, but also in other YouTube videos. I'll link the technical analysis guide at the end of this video if you want to watch it, where I really dive into more advanced concepts. But looking at trends in terms of this with break of structures by counting waves, if we're in the general vicinities, this is my first step of sort of timing and starting to set up reversals on trends. Okay, so of course the hard part, and this is the part that most people mess up, is 1, thinking that they need to be right all the time, and 2, actually being able to get into the market at the time, setting up the positions and understanding the trading math that goes into it. Okay, so now I want to move into a critical mathematical understanding that is going to completely flip the way you think about trading and probably be that aha light bulb moment when it comes to actually getting into the market and setting up positions. You're going to need to know this when we start talking about the actual strategy of where I enter the market and why. In trading, most of the battle is actually the math and position sizing rather than understanding patterns and understanding how to do charting, etc. A lot of people know technical analysis, but not a lot of people are actually able to be profitable off of it because of what I'm going to show you in just a second. Okay, so in professional trading, we use something called R factor. And as human beings, we have an issue with being wrong and losing money, right? It's just part of life. In trading, okay, it has nothing to do with being right. It's about setting yourself up in the market so that when you are right, you're making more than when you're wrong. So say, for example, we have reason to believe that we should be entering the market right here. Each time you set up a position, you have something called a stop loss, which is this red value here. And then you have something right here called your take profit. And the ratio between these two factors is called your risk reward ratio. You can see in this situation, if price moves here before moving here, I have a risk reward ratio of 4, meaning I'll make 4 times as much money if I'm right than if I'm wrong. Okay, so this area right here is what we're going to consider our risk factor. Okay, so if we enter here, we have our take profit level right there and our stop loss value here. Say we want to risk $50 on this trade. In this situation, our potential profit would be $197. If we move our stop loss up, you can see the potential profit increases significantly, but obviously the probability of you timing this exact level and having it go all the way up here before coming down here then statistically becomes less likely. Okay, and vice versa. If we make our stop loss a lot wider, the statistical probability of us getting a move up here before here becomes obviously bigger. You can see now potential profit's only $119, but the odds of it happening are higher. So of course, when we're designing trading systems, we're trying to use analysis to set up the most optimal conditions for us to be right as much as we can, so that when we are right, we're making much more than what we're losing when we're wrong. Okay, we can see a table that shows that threshold of whether you are not profitable, you're break even, or you're profitable. But this proves my point. If you're able to make 3 times what you're risking on a single trade, and you're able to do that 30% of the time, meaning you're wrong 70% of the time, you're still going to be able to be profitable at trading. Okay, if you can make 5x what you're risking and you can do it just over 20% of the time, you're still going to be statistically profitable. That means that you're wrong 80% of the time. All right, and that's what really makes this strategy so exciting, because you can see this is one of our private team members, and as you can see, he's working in these risk factors. He's not even talking about money, and his account is up 800%, and he just started about 3 weeks ago with a 52% win rate. But notice how a lot of his trades are actually that 1-to-5 and that 1-to-4 risk reward ratio at a 52%, 1-to-5, 52% is going to be extremely profitable. All right, and you'll see in a trade that I just took last week that I'm going to review in a second. All right, I closed this trade out for about 4 to 5 risk factors. So once again, in this 1-to-5 threshold, so all you really need is about a 20% win rate in that situation. And as we can be more selective about our analysis, the goal is to get it up over that. And that's what we've been able to do. However, this is only possible if we're keeping our dollar amount risk uniform each time we take a position. Because say, for example, we want to enter a position here. So we go ahead and enter with 20 Solana right at here. All right, and we're able to make $229. All right, and then say, for example, we want to enter here with our stop loss here. And we go ahead and buy with 20 units again. This time we're wrong. And now instead of risking $50, we're risking $100, still with using the same amount of units. Okay, so we can't be basing it off of a certain unit amount. The risk has to be uniform in order for the whole entire trading formula to actually work. All right, so when we're thinking about trading, we should be thinking about it in terms of risk factors, or R. So in order to create consistent R, you want to take the dollar amount that you want to risk. You're going to take your entry price minus your stop loss price, and that's going to give you the quantity that you need to buy at your entry in order to risk that certain dollar amount that you want. All right, if you want this tool that does it right on screen for you on TradingView and gives you the whole table, go in the description of this video, follow me on Instagram, DM me the word tools, and it's going to be in this entire tool suite for you, along with all of the other stuff that we do on this channel for trading. All right, but if we look at this example, we can do this right in our head, where if we take our entry value at 191.68, subtract that by our stop loss value of 186.97, that'll give us 471. If we take $50 risk divided by 4.71, that'll give us roughly 10.6 units in order to risk $50. Okay, and once again, if we click on our entry, take profit, stop loss value, we want to risk $50. You can see that will give us the exact amount of units to enter to keep our risk factor consistent. If you don't do that, you might as well throw everything else out the window, throw out this strategy that I'm going to show you. Okay, you have to keep your risk consistent in trading for everything else to follow through. All right, the second math concept that I really want you guys to understand, and this is a huge psychological one, I'm probably going to expand on this in other videos, but it's really critical for trading in general before I share with you guys the entry model. And this has to do with statistical probability, which that's what trading is. Each time you take a position, there's a certain percent chance of it going right versus it going wrong, and how much money you're expected to make when it does. In order for us to know what your average gain or loss is on a trade, or the winning percentage, we need to follow the same exact process and allow something called the central limit theorem to unfold. If you're new and this sounds confusing, stick with me. I know I can explain it to you. Say, for example, we're flipping a coin. All right, everyone knows there's heads and tails, and there's a 50% chance of either getting heads or getting tails. Everyone is confident that over time, that percentage is what happens, but I could sit here and flip heads, heads, and heads 3 times in a row. But just to sort of go to my point, even though we all can agree that statistically we're going to get each outcome 50% of the time. In statistics, you need a sample size of at least 30 based on the central limit theorem in order to actually get your averages over time. So what a lot of times people do when they start trading is they'll take a few trades and then they'll start running all the numbers. Oh, if I can only do this every single day, I'll be rich by then, or da-da-da. And it's just like, you have to understand a bell curve distribution. And what the bell curve is going to do is it's going to actually give us the average over a certain data set, which in this case is your trades. You need to let your trades unfold and you need to say, what percentage of the time am I right? And how much money am I making when I am right? Okay, and once you have that sample size of 30, then you can determine whether you're going to move into using real funds and things like that. Okay, and this sort of shifts the perspective of how much money can I make on each trade to how closely can I follow my trading rules that we're gonna get to in a second here with my own data to be able to know what my actual winning percentage and average risk reward is per trade. Okay, and with me doing that on the chart, with doing my analysis, where does that put me on this chart? Okay, we've actually done this over thousands of data points. We put together a whole back testing team. Okay, we have all sorts of examples of this strategy. Okay, I believe in testing, we ended up with an over 4 expectancy, which brings us over into this green area. Okay, if anyone's telling you that they're over here, they're probably lying to you. It's almost near impossible to be there. You're really going to be in trading right on this line. And it's a very subtle difference between making money or not in trading. That's why you have to be really consistent. That's why you have to keep your risk uniform. That's why you have to follow your rules. You have to test. And that's why it's so important to not overcomplicate things, but follow a repeatable process and really make sure that you have that proof of concept in your model, know it works. And that's sort of what I'm talking about with you guys being able to test this out for yourselves before you're even investing money into it further. A lot of people on YouTube just want deposits. They want people to start spending money immediately. That's not how I am. I spent years mastering this, and all I'm doing is boiling it down into more digestible process for you guys so that you can speed up your progress over time. And there's a lot of team members that are learning in 3-4 weeks and being able to start this process that took me years and years just because I'm boiling it down into a way more digestible form. It doesn't have to be that complicated, but you have to be strict and you have to treat it like a business. All right, so now using all of the things that we've learned so far, let's start applying this to the actual trading strategy, our entry model, where specifically I enter on these trends to be able to allow these really nice trades to play out. For this entry system, what I'm first doing is finding and identifying a trend. Okay, and what we're doing with this system is we're finding a trend, we're waiting for it to hopefully end, show signs of reversals, and then trying to build a position to trade the very beginning of a new trend. Okay, so step 1 is finding a trend. Step 2 is finding some sort of indication of a reversal. Okay, so we talked about price channels, we talked about trend breaks, okay, we talked about trend break retests, and we talked about predicting highs with Elliott wave. Okay, also you can use things like RSIs. We have an Innovatrade Pro Plus indicator, which is once again in that tool suite if you're interested, that will give you these highlight strips of points in the market where we have these significant pushes that oftentimes lead to these reversal points. You can see dip here, that was almost the exact bottom before the trend. All right, and on the private side of our team, we actually ran analysis with a ton of different indicators to be able to come up with a custom indicator that will give us ripe environments for potential reversals that in conjunction with other things will tell us whether or not to actually consider these as real reversal points. All right, this is where it gets somewhat technical. So remember what we were talking about with the change of character on trends. Step 3 is going to be waiting for a change of character in a reversal prone area. All right, so if we're looking at this on a chart, we found our downtrend here. Second step, we're finding a reversal indication. We have our change of character right here. All right, in step 4, this is where we're going to be entering at something called a fair value gap. All right, and if you're new to trading, I'm going to explain a fair value gap to you. Basically, if we take 1, 2, 3 candles here in a bullish direction, we're going to take the wick of this candle to the wick of the third candle, and the space in between here is what's called a bullish fair value gap. All right, in this situation where we have 1, 2, 3 bearish candles, if we go from the low of this wick to the high of this wick, this is also a bearish fair value gap. And what we're doing in this model is we're waiting for that reversal indication, and then we're finding this midpoint between that fair value gap. And at the midpoint, this is where I'm entering in at the markets, and our stop loss value is being put underneath the fair value gap producing candle. Okay, so stop under the candle that produced the fair value gap. All right, so if we're looking at this situation here, this candle here that sort of caused this displacement has left a gap in between here. So now we know we've had a major push out of this current trend. So if we do get a pullback down into this zone, all right, these fair value gaps are often areas where the price will bounce off and then take a continuation. Okay, and you can see in this situation, this would be where we place our position. Price comes up, pushes back down into the midpoint of the fair value gap and gets us into the trade. And one of the most important things that you can do in trading is starting to reduce risk as the trade goes into your direction. You get initial reaction, you want to take risk off the table at a place where it makes sense so that now you can only make money and you no longer are risking any of your capital. capital. Okay, so once a break of structure, like we learned about in a trend, a continuation of the new trend that we're now in on is confirmed as a candle closes above this previous high. Okay, so this would be our high. Okay, now that we have a candle closing above that high, we would move our stop loss flat. So now we can't lose any money, and now we're letting the trade run in our direction. Okay, but you can see off of our initial risk, we're already up 3.55 risk factors on this trade. All right, and the goal with this is to allow these massive trends to really play out. So it's either that this trend continues to move down, then I take my -1R, or the trade moves crazy in my direction. Now I'm reducing risk. And then what I'm doing is we're basically waiting for a 1-to-4 risk reward ratio to hit. And then I'm going out into a larger time frame because we're trading this on a 1-minute frequency. So each candle represents 1 minute worth of price movement. I'll go down into something like a 5-minute time frame, and then I'll try to find an important fair value gap on the opposite side of the trend. So notice how that the midpoint of this fair value gap is right here at this red line. Now in this situation, I would be fairly comfortable allowing this red line to be hit. All right, and then all I'm doing is trailing the second fair value gap. All right, so as we get a push, I'll bring my stop loss up to here. All right, so then my stop loss is going to go up to this second fair value gap. All right, and then it finally gets stopped out in the money for 8.8 risk factors on this specific example. All right, and this is obviously bar replay, but you can see DC22, 8.3 risk reward on Smog. You can see his entry was down here. Take profit was all the way up here. 7.2 risk factor again. Robin with the 25 risk reward. All right, so let's take a look at me setting this trade up in real time. So I identified my trend. I placed my stop loss here with my entry at my midpoint of my fair value gap. Okay, this indicator right here is a proprietary indicator that we have used with all of our data testing. We had a bunch of different indicators, and we figured out when to actually take these fair value gaps seriously, which allowed us to drastically increase our winning percentage. We had a sell indicator right here. So I took the fair value gap as an entry. I'm up about $400 on this position. Okay, and watch how I manage this trade. Okay, so you'll see I didn't reduce my risk yet. Okay, because you'll notice this candle didn't close below this level. So our rule number 3 didn't come to fruition. Notice how we get a change of character here. All right, so then I went in and adjusted my stop loss back to the entry. Okay, I was noticing pretty key support levels here on this chart. So I took this trade off the table for about $2,000 in profit. All right, here's another example of me doing this. So I have my trend here. I've identified my sell signal. We have our fair value gap with a change of character. I enter the position. This time the stop loss was outside the high here because it was a little tight in general. All right, I wait for a change of character to go underneath this low. I reduce my risk down to 0. Okay, I wait for a fair value gap on the overall trend here. All right, I was up about $2,300, and I just wanted to be done with the trade. I made 5 risk factors, so I closed out my trade in this area of support. All right, here's another trade example. Okay, so we have our sell indication. I tap into the midpoint of the fair value gap, stop loss over this candle. Price breaks down through that level. I set my stop loss to 0. I'm targeting this as my first key area of support. This trade was a little bit annoying. So price comes down, tags that perfect level that we have drawn out. I'm up $2,000, and watch how fast this flips. This is the reality of trading. So price vacuums off of that level, comes straight up, and tags my trade out for break even. All right, and then the price continued to just go way past that point. But that's just to show you why we do what we do. If we have the trend moving in our direction, we don't want to lose a full amount of money because we're looking to trade trend reversals. All right, so here's another trade setup that we have. Look, I'm geared up to try to make about $3,500. We have my change of character. Okay, price comes up and fills me through here, but notice how my overside retest is right where my stop loss was placed. I started to get concerns that this was going to come up, hit my stop loss. Okay, so I ended up taking this trade still. Trade went up against me. All right, and so I locked in my -1 risk factor. So once again, the goal isn't to not lose trades. It's about containing those losses and keeping those losses small and letting all my winners be $2,500, $3,000 multiple times per day. You take $500 hits, and all you're aiming to do is be on this side of the chart. All right, so now let's talk about scaling this and what this is going to look like as you start to put this into practice. All right, so I actually built out a tool for you. Once again, it's in that tool suite. If you follow me on Instagram and DM me tools, I'll send it over to you. But this is my personal trading desk where I basically journal all of the trades that I take. I have all of my criteria here. I have my daily checklist here and my total equity curve. So this is just an example of what you can do. But what you should be doing is testing this model out for yourself, inputting your P&L and your win or loss rate, which is going to give you your average winning percentage. All right, and then we just filter for win. We can see our average risk reward. If we're risking $10, our average win is a 1 to 5. If we have a $45 win, 61, 23, and 78, that gives us an average of 1.51 risk reward. All right, and what you can do to practice this is basically go over to your trading view, choose whatever instruments that you want to use. I like to use Solana and Ethereum primarily. And if you just hit shift forward, you can play these candles forward one by one. Okay, so what I like to do is add the Lux Algo Fair Value Gap indicator onto my chart. Okay, you can set a custom threshold threshold here. All right, and then what you can do is just play this forward and wait for different opportunities to take trades. All right, so for me, I have my sell indicator here, which once again is only for the private side of our trading team. So now I know we have a fair value gap here. I would set up my entry, stop loss over this candle, 1 to 4 initial target. Price comes up, fills that, creates the change of character, risk goes down to 0. Okay, so that's 0R. Now we have a buy side signal. Okay, I can do all of my analysis that I would like to do. Tags me into my position, reduce risk at the break of structure, targeting 1 to 4, trailing the second fair value gap. So realistically, I'd probably move my stop loss up to this value. Now I'm trailing this one. All right, so there we lock in 8.6R. So price never really comes up and taps into that zone. So I'll take this off the table. All right, so now we have our trend here. We have that change of character, fair value gap, midpoint, stop loss at break even. 1 to 4 hit. Realistically, I'm moving my stop loss after this new break of structure. All right, so then we get stopped out here. That's 1.3. Okay, so even in 2 trades, I was able to make 9.9 total risk factors. All right, so if I'm risking $500, we multiply it by 9.9. In that trading session, I would have had a total profit of about $4,900. If I was doing it with $50, I would have been able to walk away with about $500 risk, risking $50 per trade. And I think it's important for you guys to really see where this can scale. So when I'm building trading systems, I'm using something called Cloud, which I can run something called R-script, which I basically just built with AI that I can basically run. This is going to show me based on a win rate, my risk per trade, and my average profit per trade, which we can find with this, what my expected outcome would look like over time. So let's say for even example, you have a 35% win rate. Your expected profit is 1 to 4, which with this system is relatively small. Even starting with $500, you can see after 74 trades with a random assortment of losses, we can double our total trading account in 74 trades. So if we're taking about 3 trades a day, that's 24 days. So if we're trading about 4 days a week, that's 16 trades per month. So even with only being right 35% of the time and letting your winners run, okay, the data shows, and we have all sorts of proof of concept of this working in real life. Okay, I do full day trading sessions with me showing you guys. I'll put a playlist at the end of the video. If you understand the math of this trading and you're doing it properly, this is how you can scale. We saw one of our team members has 52% win rate. Yeah, that's like 49 trades in order to double your trading account. All right, so if you're taking 3 trades a day, that's 16 trading days. Or you can see some members are taking a ton of different trades on the given day. So he's able to get an 800% growth in something like 3 weeks. And you can see I've always looked at support and resistance patterns, but InnevaTrade has helped me structure my trades with specific strategies. Okay, so once again, diving into not only this framework, but so much more on the private side of our team is allowing us to develop a ton of crazy things. All right, we're only going to continue to get better into 2025. All right, and sort of just to prove this concept of scaling for the new year, I'm going to trade some of my days, obviously not all of them because I still want to make money trading, so I want to trade with large sums, but some of the trading days I'm going to be trading on a $100 account, and I'm going to be documenting it primarily on Instagram. So if you want to follow me on Instagram, I'm going to be dropping reels about it, sort of teaching what I'm doing, what I'm going through emotionally as I'm growing that small amount. The goal is to be able to start with 100 and be able to make $1,000 in a single day at a certain point, to show you that this math is really what matters and not how much money you're starting with or getting lucky or trying to read news or do anything crazy. And then however long that takes me, at the end, I'm going to have it on YouTube and explain the whole process as well. All right, so if you're interested in that, follow me on Instagram, subscribe to the channel if you haven't already. If I helped you understand complex concepts, make sure you hit the like button for the video. Okay, check out these playlists to learn more. But until next time, I'll see you all in the next one.